Welcome everyone to this explainer. Today we're looking at a strategic visual guide designed specifically for directors and managers. You know, we're really going to transform depreciation, which, let's be honest, so many people just view as this mandatory boring accounting chore. We're going to transform it into a powerful financial lever for your business. We have a lot of great ground to cover, so let's get right into the analysis.
Okay, let's dive into this. Is depreciation just accounting? I mean, it's a fundamental question, right? Do you view this concept merely as a paper loss on a spreadsheet, or do you recognize it as the strategic tax and cash flow reality it truly is? By the end of our time today, I guarantee you're going to see it as the latter.
Here's a quick roadmap for today. We'll start with the cost of wear and tear, then hit the impact on financial statements, the straight line method, accounting versus tax depreciation, cash flow and acceleration, and finally, a real-world strategy to optimize your investments. Moving right along. Section 1. The cost of wear and tear. Before we get into all the complex financial modeling, we really need to ground this whole abstract concept in physical, everyday reality.
Fundamentally, depreciation is just the decrease in value of an asset over time due to physical wear and tear, age, or functional obsolescence. According to IFRS Section 17, which is the rulebook governing property, plant, and equipment, depreciation is the vital mechanism we use to estimate this continuous loss of value. And that loss starts from the exact moment an asset is in working condition and ready for use, all the way until it's ultimately discarded or sold.
I actually really love this quote from Gonzalez from our sources. The reduction in the earnings of a company that results from the breakdown of tangible assets due to wear, age, or physical condition. It's powerful, right? Because it reminds us that these causes can be purely physical, like weather exposure, functional, like a bad accident, or even contingent. And here's the kicker. If you aren't tracking this effectively, it literally degrades your company's long-term competitiveness.
And this brilliantly illustrates the real-world stakes. Consider this analogy from Scotiabank. Imagine your company buys a commercial car fleet for $100,000. After a year of intense, heavy use, because of wear and market obsolescence, that fleet drops in value to $80,000. That $20,000 drop, that is your depreciation. What's absolutely crucial to understand here is that banks use this exact calculation to evaluate your company's loan capacity. They need to ensure the assets they're financing will actually hold enough value to back the loan.
Moving right into Section 2, the impact on financial statements. Now that we've grasped the physical reality of wear, let's shift our focus to how this loss actually ripples through your company's financial records.
This is a really vital comparison to make. Depreciation has a dual impact on your finances. On the balance sheet, it steadily reduces the asset's book value year after year until, eventually, it just disappears. But, and here's the catch, simultaneously, over on the income statement, it acts as an expense that directly shrinks your net profit. Think about it for a second. The more you use an asset, the more revenue it generates, sure. But that heavy use also means a higher depreciation expense, which mathematically lowers your reported utility and net profit.
Okay, Section 3, the straight line method. Let's look at the baseline method accountants use to model a predictable, even drop in value.
Let's break this down with a practical, easy example. Say you buy a piece of office machinery for $10,000. You expect it to last 10 years, and you figure you can salvage it for $1,000 at the end. The straight line method takes that $9,000 of consumable value and simply divides it by 10. That yields a highly predictable, steady $900 reduction in utility every single year. It's simple, it's consistent, and it evenly impacts your net profit year over year.
Let's move to Section 4, accounting versus tax depreciation. Now, this is where things get really interesting plot twist style, because how your accountants view your assets is very different from how the government views them. There's a pretty stark difference here. Accounting depreciation, which is governed by IFRS, is meant to reflect the accurate, useful life and the true health of the asset for your shareholders. It's all about presenting a realistic economic picture. On the flip side, tax depreciation follows rigid rules set by tax authorities to determine your legal tax deductions. To give you a practical example, you might depreciate a new computer server over 5 years for your shareholders to show its true lifespan, but simultaneously write off the entire cost in just 1 year for the IRS to maximize your immediate tax deductions. Your books and your tax returns are literally telling two different stories, and understanding both is absolutely essential for corporate financial planning.
Which brings us perfectly to Section 5, cash flow and acceleration. Let's explain the strategic magic of how a so-called paper expense
directly influences the real, hard cash sitting in your bank account.
Now, what's really interesting about this slide is that $2,000 figure. Remember that $10,000 machine from earlier that gave us a steady $900 deduction using the straight line method? Well, if you use a 20% declining balance accelerated method for tax purposes, you get a massive $2,000 deduction in year one, instead of just $900. You're heavily front-loading your expense recognition.
Why on earth do smart managers do this? Because a non-cash expense creates a tax shield, or an escudo fiscal. Depreciation doesn't trigger an actual cash outflow today. I mean, you already paid for the machine when you bought it. By claiming higher accelerated depreciation early on, you significantly lower your taxable income for that year. You pay less in taxes right now, which directly and positively modifies your projected annual cash flow. It keeps more real cash in the business for immediate reinvestment and operational growth.
And finally, Section 6, Strategy to Optimize Investments. Let's see how this builds our final playbook, translating all these financial mechanics into a practical strategy for company directors.
So, the crucial point is that this strategy comes down to four main pillars. Managers must actively use depreciation to 1. Plan capital expenditures, or CAPEX, meaning you actually have the cash reserves mapped out and ready when a machine inevitably dies. 2. Calculate ROI accurately when evaluating new projects by factoring in these long-term costs. 3. Optimize tax deductions using accelerated methods where legally beneficial. And 4. Strategize asset replacement before obsolescence destroys your competitive edge and efficiency.
We've covered a lot of vital ground today, from physical wear and tear to sophisticated tax shields. But I want to leave you with one final, provocative question. Are your assets working financially for you? I challenge you to rethink your balance sheet entirely. It's not just some passive historical record. It is an active toolkit. Understanding how depreciation deeply impacts your profit, your taxes, and your real cash flow is exactly how you optimize your own investments and guarantee operational success. Thank you so much for joining me for this explainer, and I really hope you look at your next major equipment purchase in a whole new strategic light.